You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
I'm going to invite up a good friend who worked at my fund. I hired him and then fired him within a week. Not his fault, but the coffee always sucked. But I decided to shut my hedge fund, so he has a little bit of bad luck, Danny. But Danny just passed the CFA, so everybody round of applause. Probably the hardest exam to pass. He's single. He's thin. He shops at Nordstrom. These are all true things. These are all true things. And he is a analyst for hire, one of the smartest kids that I know, lives here in San Diego. And I asked him to do a myth bust for us, a little 5-minute, we're testing an idea. And I said, let's talk about buybacks. He was going to do a quick myth bust about buybacks. And then we're going to wrap up the morning. I'm going to stay through lunch here, but we'll wrap up the morning with fixed income, with X-Ignite, and then as long as we want, panel with Vili and Michael Porat. Me, Michael, and Vili, VC, Corp Dev, and you can ask questions. It'll be a great event. They're here. They got in late. So we'll do them just before lunch. So take it away quickly.
Beautiful.
Make it happen.
Which button is the laser pointer button?
You're the CFA.
Not a technology expert, though. Left, right, and then...
Right, left.
And then maybe that. All right, perfect. Okay. Howard, thank you for that introduction. That's great. I'd like to introduce myself. My name is Danny, and I have a high claim. This is going to be the most exciting corporate finance presentation that you see this week. I can assure it. So the purpose of this was there's a popular misconception that buybacks are inflating the market, that perhaps they're changing market valuations, and I thought this would be an interesting enough topic to at least get your attention while also not being so offensive as to not have any friends in the audience when I'm done. So the question that I'm going to discuss is, are buybacks affecting stock valuations? And I think you'll see as we run through the contents that the answer is no. So this is going to be a quick presentation, and also I think one of the most aesthetically pleasing slideshows, but I have to warn you there is one accounting slide, maybe two. So just bear with me on that. We're going to talk about the news. How are they misreporting buybacks? We're going to talk about the reality, how buybacks are a transaction that is a return of shareholder capital and that it cannot create new value. And I have a pizza analogy that I know all the New Yorkers are going to love, especially Josh, maybe Jassy. We've got, why is there a trend towards buybacks? Why, as a corporate finance decision, does that make sense? And then we've got some data, because I know there are people that appreciate some empirical numbers behind what I'm talking about. So let's get into it. Zero Hedge. Obviously, they are a highly histrionic news source. But what are they saying? They're saying it's an illusion. Not only are buybacks propping up the market, but it is an actual illusion. Even if you prefer Bloomberg as a more staid and true to reality news source, they too, the only buyer keeping the market alive is buybacks. In a way, it's sort of a ridiculous concept, but they're reporting it, so we're going to get into it. Now, what's the reality of the situation? What is actually happening? And here's the accounting slide, so just bear with me, do not grab this slide inappropriately. I'm upset as well. We'll get through it. We've got a very simple balance sheet: assets, liabilities, and equity. They each equal $200, the accounting equation balances. Now, we've taken $25 from the income statement that we made at our lemonade stand, or maybe some other sweet business, and we have 100 shares. So if you make $25 over 100 shares, our earnings per share is 25 cents. I think we can agree. And our stock price is $5. Do not worry about the PE multiple. The PE multiple is a number that you back into. We know what the stock price is. We can look it up on the news. We know what the earnings are. We can look that up on the news, and whatever the, whatever the ratio is what the PE multiple is. It's an immaterial number. It's a bad measure of valuation, and I wish I could talk about that, but we're doing this instead. So $5. What if we take our entire $25 and pay that out as a dividend? Because remember, my assertion is that a buyback is a return of shareholder capital, nothing more, nothing less, and that it can't create new value. So let's see what happens when we do a dividend. Dividend, what are we doing? We're gonna pay our entire $25 out. So our retained earnings goes from 125 to 100. Correspondingly, our cash goes from 100 to 75. We've paid out $25. We have 100 shares. That means that the equity value of the stock has gone down by 25 cents. So keep in mind what is happening when you are buying a share of stock. You are buying a portion of the current equity value and the promise of future returns. So if we're giving away 25 cents of equity value, then when the stock goes ex-dividend, we're gonna have a $5 stock going down to $4.75, but you're also gonna have 25 cents in your pocket. Guess what? Same thing, $5. So we're good to go. And I don't think anyone out there is arguing that dividends are propping up the market. So when I prove to you that this is economically the same transaction, you should see that dividends are merely a form of return to shareholders and not some magically pernicious way to like prop up valuations. So the next slide, slightly complicated. Again, we're gonna take our entire $25 we earned and we're gonna pay it out to shareholders. Now in this particular case, our $25 of net income is also our free cash flow. Free cash flow is a slightly different metric. It's actual cash. Earnings can be highly adjusted based on depreciation. If you have more debt, then you have greater interest expense. If you have greater interest expense, your earnings are going down. But this is slightly different than what is the core business. How are you making money? What is the competitive landscape? So in a way, earnings per share is like the worst number to look at. It's required by accounting rules, but it's not necessarily giving you a clear picture of the economic reality. So we've got our free cash flow, excuse me, 25 bucks. We know that the price is $5. We know that we have 100 shares. So we know that the total value of the firm has to be $500. So again, we're just backing into what we think the expected future value must be because we've got these stated facts and we just fill in the blanks. So we're gonna take that $25, we're gonna return it to shareholders in the form of a buyback. So what are we gonna do? We're gonna buy $25 worth of stock. We know the stock is $5. What does that mean? We get to buy 5 shares, 25 divided by 5. So now we've got the remaining value as hypothesized by the market, a lowered share count, and guess what 475 minus 95 is? $5. So now I can tell that we just did 3 accounting slides, so give yourself a small round of applause. And half the audience is like, why? Why is he subjecting this to us? I have a very simple visual illustration of this. When you buy stock, you're buying a share of the equity. If they decide to have 100 shares of equity, or 1,000,000 shares of equity, or 1,000,000,000 shares of equity, or 2 shares of equity, it does not change the size of the equity that you are being divvied up among. So if you think of this as a piece of pizza, you can cut it, we could share one pizza, this whole audience. Now granted, everyone's gonna get a very tiny slice. If I decide to do a buyback and buy back some other slices to give you a greater share, that is a return of capital. It does not make the pizza bigger. And I think that is the clearest illustration of this phenomenon. You can't grow a pizza by buying more or less of the same pizza. The diameter is the diameter. So now that we've talked about the reality, we've gone through how economically it's the same transaction as a dividend and why you would not value stocks higher because they're necessarily returning money to shareholders, we're gonna get into the trend very quickly. Why is this happening? This started with an SEC rule in the 80s that basically gave guidance to companies about how they could buy back shares and not be accused of manipulating their own stock. Now, if you have any faith that the management is a good steward of shareholder capital, of course they are going to pick a transaction that is a non-taxable transaction. Keep in mind, dividends you have to pay ordinary income taxes on, which are high and possibly going higher, whereas a buyback is a transaction that gives you a bigger slice of the pizza, remember, but is a non-taxable. So of course that's an advantage for you. We've also got a couple of, oh, by the way, I picked these icons very purposefully, so take note of that. Of course, with corporate finance, if you're issuing options to your executives, that's dilutive. The least they could do is buy those options, buy the stock back and keep the ratio of capital stock the same. You also have the idea that if you're buying stock with your equity, what's happening? Your equity is going down. You're spending it on buybacks. So a simple metric like return on equity, net income over equity, if the equity is getting smaller, what happens when a ratio in the denominator gets smaller? It goes up. So your return on equity is going to go up. It can change a little bit of your valuation metrics that way. The most important thing, though, is the signaling effect. I want you to think for a moment, what would happen if a company says, we're issuing a dividend, and then 2 quarters later they go, just kidding, we're investing in a plant, no more dividend. The stock would get crushed. In most cases, if a company comes out and says we are lowering or canceling our dividend, it is a negative event for shareholders. With a buyback, and as we just proved, same economic transaction, there is no signaling effect. They can start it, they can stop it, there's no press release, no one cares. You get the same benefit, non-taxable transaction, return of shareholder capital, but they're not getting crushed, in the CNBC news cycle about how they've just canceled their dividend. The last thing is possibly avoid managerial incompetence Twitter icon. And this is an agency issue. It may seem strange to you, but the more cash that a company has, the actual greater propensity for them to misuse that cash. There is a chance that they invest in foolish projects. There is a chance that the guy has a crush on some girl who works at another firm and decides to give her a contract instead of someone else. And what that basically does is it wastes shareholder capital, and as a shareholder, you shouldn't want that. So this is the hard data, and this will be my last slide. To test empirically if there is actually any relationship between buybacks and market returns, I went to FactSet and I got the net distribution of shareholder capital that includes buybacks and dividends. I plotted it out for the last 7 years, quarter over quarter, and I looked at market returns. You'd expect that if buybacks are up, let's say 100% quarter over quarter, and the stock market is up 10% quarter over quarter, and there's a positive correlation, then you could at least propose as an argument that there is, in fact, buybacks propping up the market. So here's the data. You can see that in this particular big blue bar, the buybacks were up 60% quarter over quarter, and correspondingly, this purple bar, the market was up around 10% that quarter. That's great. Well, I also colored them when they are moving in opposite directions red. So as you can see, there's a lot of red in here. Not only that, the correlation is actually negative. And not only that, the correlation is so profoundly negative that with a 95% degree of certainty, you can say that these two data sets are dissimilar. So if you've ever had a biotech stock blow up on you because it didn't meet some end-stage trial at phase 2 or whatever, that is essentially what they're testing. Does this treat anything? No, it doesn't. Stock goes down 95%. These data sets are so unlike each other that they are actually statistically significant in illustrating that quarter over quarter changes in buybacks do not have any effect on the market. So to conclude, what was the point of this presentation? There's a popular misconception that buybacks are propping up the market. I proved to you in some highly illuminating accounting slides that they are an economically identical transaction to issuing a dividend or return of shareholder capital. I took it a step further and explained why not only is there a negative correlation, but it's actually a statistically significant negative correlation. And now you are powered with the knowledge to go forth and spread this so we can no longer deal with this meme. And while I cannot assure that necessarily corporate finance is the appropriate subject to necessarily seduce the next beautiful woman or dude that you meet at a cocktail party, what I can assure you is that everyone will be impressed with your corporate finance acumen. So I appreciate your time, Howard. Thank you. Oh, and one more thing.
And this is why Danny's single.
He might not be wrong. If there's anything else that you want to talk about in relation to what I presented, find me, and I'm happy to go into greater depth about it. Thank you.
Thanks, Danny. Stefan?
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.